Let's jump right into this explainer. Today, we're unpacking what might just be the most captivating corporate heist in modern history. We're going to dive into the wild story of Enron, a company that went from being the absolute undisputed darling of Wall Street to becoming a massive cautionary tale of corporate greed. And it all happened in the blink of an eye. 63 billion dollars. Just wrap your head around that for a second. That is the staggering amount of money in assets that completely vanished when America's seventh largest company suddenly filed for bankruptcy in December of 2001. At the time, it was the largest corporate collapse in U.S. history. Which leaves us with a huge lingering question. How on earth does America's seventh largest company just poof, vanish into thin air? Over the next few minutes, we're going to break down exactly how this company sold the illusion of the future, all while making billions off of literally nothing. Section 1, the setup, the illusion of innovation. Now, a crash this massive doesn't just happen overnight. Enron actually started out in 1985 as a pretty straightforward, kind of boring natural gas pipeline merger. But thanks to political deregulation of the energy sector in the 90s, which was a policy championed by both the Clinton and Bush administrations, by the way, the rules of the game totally changed. Enron evolved from simply pumping gas to wildly speculating on energy markets. By 1999, they launched Enron Online. This was a digital marketplace where you could trade energy contracts globally with just the click of a button. They pitched themselves to Wall Street not as a stuffy utility company, but as a disruptive tech innovator. By the year 2000, their stock peaked at over $90 a share, and they were trading absolutely wild, intangible commodities. We're talking broadband bandwidths, and yes, literally trading the weather. Section 2, the crew, the architects of fraud. Every great heist needs a crew, right? And here, there are three main players you absolutely need to know. First up, we have Ken Lay. He's the founder who held a PhD in economics and leaned heavily on his political connections to push for that deregulated market. Next is Jeff Skilling, the fast-talking CEO brought in from McKinsey to transform Enron into a massive trading floor. And finally, Andy Fasto, the chief financial officer. His main job was essentially financial storytelling. He used incredibly complex accounting to magically make the company's crippling debts disappear. Skilling was totally obsessed with this cutthroat Darwinian philosophy. He famously believed that money was the single only thing that motivated people. So he instituted a ruthless employee grading system where the bottom 10% of the workforce was mercilessly fired every single year. It created a highly toxic pressure cooker environment. Employees were grinding out 18-hour days, willing to do almost anything to hit their quarterly targets and secure those massive bonuses. Section 3, the con, the phantom profits. So to understand how they pulled this off and managed to completely fool Wall Street into believing they were endlessly profitable, we have to look at their first major trick, mark-to-market accounting. It's essentially counting your chickens before they hatch, or honestly, before you even know if you have chickens. Here's how it worked. If Enron signed a 10-year energy contract, they would immediately write down all 10 years' worth of projected future profits on their books the very day the contract was signed. Even if the deal eventually fell apart or the client flat out couldn't pay, Enron still instantly claimed millions in fake, completely subjective profits on paper. But wait, what happens when the actual cash runs out? Well, that's where Andy Fasto's highly illegal three-step trick came in. Step 1, he created outside shell companies, known as special purpose entities, giving them ridiculous sci-fi names like Jedi, Chuko, and Raptor. Step 2, Enron would take its failing, toxic assets and sell them to these entities just to get the losses off its balance sheet. But here's the kicker. Step 3, Enron was secretly funding these entities with its own money to fake the sales. It's basically like selling your broken down car to your dog, paying for it with your own credit card, and then proudly bragging to your investors about the profit. It was a complete sham. Section 4, the unraveling, the house of cards. You know, an illusion can only last so long before the cracks start to show. And the unraveling really kicked off in early 2001. A Fortune magazine reporter named Bethany McLean was looking into Enron's massive stock gains. And she asked this incredibly simple, yet completely devastating question. How exactly does Enron make its money? When she asked Skilling, he couldn't answer her. When she asked Wall Street analysts, they actually laughed and admitted they didn't know either. It exposed the stark reality that absolutely no one understood Enron's deliberately confusing business model. From that moment, panic set in.
And it set in fast. By August 2001, Jeff Skilling abruptly jumped ship, resigning for personal reasons, right as things were getting incredibly hot. That exact same month, an internal whistleblower, Enron VP Sharon Watkins, sent an urgent memo to Ken Lay warning of an impending accounting implosion. By October, the game was up. Enron was forced to publicly admit they had cooked the books, declaring over $600 million in fake earnings. And immediately after that, the SEC officially stepped in to investigate those smoky balance sheets.
Section 5. The impact. The catastrophic fallout.
Once the truth was finally dragged into the daylight, the real-world devastation was absolute. In a matter of mere months, Enron's high-flying stock plunged from its peak of over $90 to under a single dollar per share by late November. The market just froze, and 99% of the company's value simply evaporated into thin air. And the brutal injustice of the whole situation, it's just staggering. While the executives who orchestrated this massive fraud were busy cashing out hundreds of millions of dollars right before the crash, and get this, even received $55 million in bonuses during the bankruptcy process, the regular employees were decimated. 20,000 workers lost their jobs, they lost their medical insurance, and because leadership actively encouraged them to put their 401k savings heavily into Enron stock, they lost their life savings. Their average severance pay? A measly $4,500. And to make matters even worse, the very people who were supposed to be guarding the henhouse, the trusted auditors at Arthur Andersen, were actually helping hide the fraud. Because they were raking in millions in consulting fees from Enron, their objectivity was completely compromised. When the federal investigation launched, Arthur Andersen employees frantically shredded one entire ton of financial documents to hide the paper trail. Literally, a ton of paper. Ultimately, the architects of this massive fraud did have to face the music. Heavy prison sentences were handed down across the board. Ken Lay was convicted of fraud, though he actually died of a heart attack before he could be sentenced. Jeff Skilling was slapped with a 24-year prison sentence. Andy Fasto cut a deal, testified against the others, and served 6 years. And Arthur Andersen, that 90-year-old accounting firm, completely collapsed, resulting in 85,000 people globally losing their jobs.
Section 6. The final lesson. Illusion versus reality.
So, what can we actually learn from this historic disaster? Well, this quote beautifully sums up the entire saga. Enron proves the extreme, very real danger of a corporate culture that prioritizes short-term stock prices over basic, fundamental ethics. It shows us exactly what happens when the whole world blindly accepts the illusion of success, simply because the numbers look good on paper and the jargon is just too complex to understand. So, as we literally see executives from this era, like Jeff Skilling, finishing their sentences and actively trying to re-enter the business world today, I want to leave you with this question. Keep it in mind the next time you see a miracle company making headlines. When something seems too good to be true, are you brave enough to ask, why? Thanks so much for diving into this incredible corporate story with me. Keep asking those tough questions, and I'll catch you in the next explainer.